Hello, this is Bill Bateman back with you. So far we've talked about in the first video how to approach a case when you're looking at it for the first time. The second video we talked about what should be in the introduction of your evaluation report. And in the third video, Dr. Moore gave you some hints on what you might use for a strategic analysis and then how that strategic analysis should be used in your final evaluation. What I'm going to do in this video is briefly go over the projections and assumptions. This is the third part of your report. I'm going to warn you right now that for some reason students will get through the introduction and the strategic analysis okay, but then they immediately want to go to the discounted cash flow or the market multiples. If you do this, you're missing a big part of the rubric, and your score will be adjusted accordingly. So in a real life situation, the projections are normally provided to the analyst by the customer, and it's the analyst's job to review these projections and the underlying assumptions to see if it makes sense. So here you can see that we have a 5-year projection for Mercury Athletic, the cash flow forecast. And you see that it starts with with revenue and then takes out expenses to get to an operating income. This is also the EBIT that we're using in our free cash flow formula. And they have it for each individual division, and then they have consolidated revenue at the bottom, or I should say in the middle of the spreadsheet. Now, this consolidated income that we see here that I've just highlighted, that's what you would use for your EBIT in a free cash flow, which we'll see in a future video. The customer or client has also provided you with estimated capital expenditures and estimated depreciation expense. Now, the depreciation expense, if it's not given to you, should come from the income statement. If you pick up an amount off the balance sheet, you might make the big mistake of taking accumulated depreciation, which would be totally incorrect. Or even sometimes if you take the difference between accumulated depreciation from one period to the next, it's not the actual depreciation expense, particularly if there had been a disposal of equipment during the period. Normally, a client or customer or organization has also provided you with their capital expenditure budget for the planning period. Now, there may be times when you're not going to have this, so there is a way to proxy this. Well, and that's another way of saying to estimate it. If you think about a company that was completely stable, wasn't going to grow anymore except at, say, the rate of inflation and the growth in the GDP, so 3 or 4%. So they're in a long-term growth mode. What would the capital expenditures look like? Well, if you think about what depreciation is used for, it's used to replace worn-out equipment. So if you're not growing, you still have to have some level of capital expenditures to replace what's wearing out. So in that situation, your capital expenditures could equal your depreciation expense. But what about in a growing company? Well, you could say that your capital expenditures would be enough to cover the depreciation plus enough to cover the new growth. So a way to estimate what your capital expenditures might be would be to take the depreciation expense times 1 plus little g. And that would give you an estimated capital expenditures over the planning horizon. Now again, it's best to try to get a hard number or at least an estimated number from the company that you're doing the valuation for. So there's the first set of assumptions that you might want to look at. Okay, going back to revenue, they've broken down revenue for the 4 divisions, and they've actually done a really nice job of estimating their growth rates. So this is your assumption that gets you back to these revenue numbers, like here and here under men's casual and women's athletic. And we'll come back to women's casual in a minute. But after reading through the case, do these numbers, these growth rates, do they make sense? Well, if the case says anything about the athletic shoe space being that space that has the most potential for growth, you could say these are pretty good assumptions. But if the case says something different, you might want to question them. Women's casual, you can see it has a 0% growth. And if you look back to the projected revenue after the first year, they're going to exit that business. So there will be 0 sales and there will be 0 operating expenses associated with those sales. The next thing you want to do is look at the EBIT margin, which is the earnings before interest and tax, or this operating income that we talked about earlier. And do these make sense? Are they taking the appropriate amount of expenses to get to this number? And then they're estimating the corporate operational or overhead and revenue as well. And it's constant throughout. Does that make sense given the plans that the company has for Mercury Athletic? So again, your job is to review all the projections, and they could be in a format similar to this, or it could be a little bit different. But your job is to review these projections, make comments on them, and if you have changes, go ahead and make the changes. But you're going to have to be able to validate and defend any changes. At the very least, you have to write about the projections and why you feel they're right or correct, or why you feel they should be changed. Again, don't forget this section. For whatever reason, students seem to skip over it and miss it completely.